Hey and welcome back to the channel. So here's something crazy for you. Did you know that the average American makes $1.7 million over the course of their lifetime? And at the same time, a whopping 39% of Americans don't even have enough in their savings to cover an unexpected bill of just $400. It's not just America either. This pattern of earning decent money and yet having very little savings, it's seen all across the developed world. That's why in this video, I want to share with you the 7 rules of money. These rules are simple, but extremely powerful. These rules, they're not some magical solution to every problem, but I can tell you with absolute confidence that if you can start following even just 1 or 2 of these rules, number 1, they're going to help you to earn more money. And number 2, they will help you to keep and grow more of what you earn. And just to say up front, no, the answer isn't to buy my course or anything like that. I don't even have a course to sell you. I mean, I don't know about you, but I'm not really a fan when you watch these types of videos and it turns out it's just one long rubbish sales pitch for a course. No, in this video, I'm just going to talk you through the 7 rules of money and give you some strategies you can use to make them easy to follow. I don't want to waste any more of your time either, so let's just get straight into it. The first rule of money is to pay yourself first. So let me ask you a question. When you get your paycheck, what's the first thing that you do? I'm going to guess it's probably to pay your bills, maybe your rent, your mortgage, your car bill, etc. After that, what do you do with your leftover money? 99% of people will spend the rest of their money. And then if they have any money left over after at the end of the month, they might save that. So if this sounds like you need to listen to this. Paying yourself first is a really simple but powerful concept. Basically, it's just changing the order of how you do things when you get paid each month. So when you get your next paycheck, the first thing you should do is take 10 to 15% of it and put it into a separate account. Even better, set up a standing order and automate the process so you don't even have to think about it. Once you've done this, you can pay your bills. And then whatever you have left over after this is your spending money. So many people think of savings as optional and then they wish they had more savings at key points in their lives. Once you start putting your savings first and think of that 10 to 15% as like a bill that you have no choice but to pay every month, you'll soon adjust and your savings are going to grow rapidly over time. The second rule of money is to invest the money that you save consistently. So you've probably heard that compound interest is a good thing. Well, I'll take it a step further. Investing your money is the single biggest thing you can do to take a step towards being financially free. Don't just take my word for it though, let's actually run some numbers. So the average American earns just over $52,000 per year after tax. To keep things simple, let's just round that down to $50,000. Let's assume they save up 15% of their salary. That is a saving of $7,500 per year. If they work for 40 years, that is a total saving of $300,000. That's not bad at all, but let's see what happens if we take those same numbers and this time, instead of just saving the money, we're going to invest it into the stock market. Over the last 100 years, the American stock market has returned 10% on average per year. So let's use this as our yearly figure. Once we run the numbers through again, we get a final result that you might not even believe. $3.5 million. Okay, that difference seems almost too crazy to be real. So let's jump over to our calculator and see how this is possible. We can see here that the initial balance was $0. The total monthly deposits over the 40-year period, they were $300,000. And we know this is correct as this is how much we had deposited in the other example before we invested in the stock market. And the annual interest rate is 10%. That does all seem correct. You see, in year 1, we deposited a total of $7,500, spread equally over 12 months. And we earned just $400 in interest. In year 2, we deposited the same amount, but this time the money we earned through interest jumped to nearly $1,200. You see, when we say earning 10% interest, think of it as like growing your own money pie by 10% each year. As your money pie grows over the years, that 10% is going to be a bigger and bigger slice each and every year. So in the 8th year, something really interesting happens. This year, we deposit the same $7,500, but we actually earn a massive $7,900 from interest alone. This is the first year we've earned more from the interest than the amount we've saved from our job. And if you know anything about how exponential curves work, those numbers are about to start growing rapidly. In year 20, we earned just under a whopping $41,000 from our interest alone. And if we go all the way to the bottom of the chart, in our 40th year, we are still only depositing $7,500. But now we're earning nearly $300,000 in interest in just one single year. All in all, if we add everything up, we have deposited $300,000 in total, and we've earned just under $3.2 million from interest, bringing our total to a quite remarkable $3.5 million. So rule 1 is to save up 10 to 15% of your income by paying yourself first. Rule 2 is to invest that money frequently and consistently. Rule 3 is to diversify and take risks according to your age. So the example I just showed you made the assumption that you invested 100% of your savings into the American stock market, and then you received the average return. This can be a great strategy for some, but there's a slight caveat to this. So in 2020, the stock market fell by 34% in just over a month. While this is a pretty extreme example, history is littered with times when the stock market has crashed. If you have the nerve to hold on and see it through, the stock market historically has bounced back and climbed higher than the previous peak. Problem is, we all fall foul to human nature. When we see something crashing in value, we all start thinking to ourselves,
what if it continues crashing? What do I do then?
We panic ourselves and we often end up selling near the bottom of the market, or just not investing as consistently at the bottom. And then we kick ourselves when the market bounces back. But there's a solution. What if we could reduce those huge swings in the market? What if we could just smooth things out a bit? This is what is known as diversifying. And it's pretty simple, really. Essentially just means buying more than one investment. So for example, if you buy an S&P 500 fund, you're buying a small piece of America's 500 largest companies. That's a whole lot safer and more diversified than buying just one company. For example, there is the Spider S&P 500 ETF. I'll post a link in the description so you can learn more, and if you choose, invest into it. If you buy some foreign stocks too, that's even more diversified. For example, you could take a look at this Vanguard investment, which invests into the biggest companies in the world outside of the US. Again, there's a link in the description. By the way, if you use the link in the description, you're also going to receive 2 free stocks worth up to $1,600, and you'll be supporting the channel at the same time. You also have to think about your age and when you're planning to cash out. You see, the longer you have before you need to spend your money, the more you can afford to just keep holding through the ups and the downs. If instead, however, you need to cash out in the next few years, let's say, you might want to think about investing some of your money into other investments too, just in case the stock market is going up and down, such as real estate, gold, or bonds. The 4th rule of money is to pay off high interest debt. So far, we've talked about how to save up your money and invest it so that it grows over time. We've seen how even the average person can grow some serious wealth over time. But there's one thing that's always going to be your biggest enemy on this journey: high interest debt. So imagine it like you're swimming along in the open water, and each time you put money into your savings account, it's like you're making a stroke forwards and moving closer and getting closer to your final destination of being financially free. As you begin to invest and compound your money, you feel the tide beginning to rise, pushing you forwards faster and faster. With the tide on your side, it makes the journey a breeze and you can get to the end quicker than you probably ever thought was possible. If compound interest is the tide pushing you forwards, high interest loans are the tide pushing you backwards. When you're paying high interest loans At times, it might feel like you're putting in so much effort just to stay still. So, what is the solution? Well, I think it goes without saying, if you can, try to avoid any debt with over a 10% interest rate per year in the first place. But unfortunately for many people, it might not be possible to avoid. So the question is, what should you do if you already have high interest debt? So you've probably heard the idea that a dollar saved is as good as a dollar earned. Well, the same principle goes to investing and paying off debt. If you have a loan with a 10% interest rate, every dollar you pay off is the same as investing a dollar and earning a 10% return. Again, every dollar you pay off is the same as investing that dollar and earning a return identical to the interest rate. So for example, if you have a loan with a 15% interest rate and you earn $100, you have two choices. Number one, you can either pay off $100 of the loan, or number two, you can invest that $100 elsewhere. If your instincts are telling you to pick option two, to invest the money instead of paying down the debt, don't worry about that at all. You're not alone. It's our human nature to want to grow things instead of paying off what we owe. But here's the thing, if you have the option to get a guaranteed 15% return on your money, you are not going to find a better investment out there than that. So the key is to pay off any high interest debt before you invest your money. Considering that paying down debt is a guaranteed return on your money as well, whereas the stock market will fluctuate, a good rule of thumb is to pay down any debt with an interest rate above 5 or 6% before you invest. Speaking of debt, if you want to grow your wealth, the fifth rule of money is to understand the difference between good debt and bad debt. And I know what you're thinking.
Good debt? Are you crazy, Tom?
Well, okay, but firstly, bad debt. I think we all kind of instinctively know what it is. It's things like credit card payments, car lease payments, etc. But what exactly is good debt? Good debt is when you take out a loan to make a sensible investment into your future, which should leave you in a better position in the long term. For example, a mortgage. We often forget that a mortgage is just debt at the end of the day, just like any other type of loan. We forget that because, it's a mortgage. It doesn't really feel like it's debt. But the reason that a mortgage is good debt is because it allows you to buy a home to live in, and it also means you're investing into real estate. Generally speaking, if you hold real estate for long enough, it usually increases in price. Investing in your business can also be an example of good debt. The key with good debt is just to use it sensibly. And what I mean by that is don't take on debt that you can't afford to pay. Don't buy a house where the mortgage payments are stretching you thin. Buy something realistic, which allows you to save up money on the side. If you invest that extra money you're saving into the stock market, which generally tends to grow more quickly than real estate prices anyway, you can always buy another larger house further down the line. Do not max yourself out on your first property, but also understand the good debt is very different to bad debt. The sixth rule of money is to study people smarter than yourself. Best of all, don't just listen to what they say. Watch what they do. Find people you look up to and follow their actions. Now, thankfully, in today's world, following top investors and financial gurus, it's easier than ever. Who you follow is up to you, but I'll give you some great names that you can keep an eye out for. Warren Buffett, arguably the greatest investor of all time. Buffett focuses on long-term, fundamental investing. Ray Dalio has been one of the greatest investors over the past 40 years, and he regularly does interviews and gives his honest thoughts on what's happening in the market. And Cathie Wood runs the most profitable public fund over the past 6 years. Her fund focuses on innovation and the companies building an exciting future, such as Tesla and Square. Now, these three names are a great starting place. And do you know what's even better about following these three? They rarely agree with each other. Okay, so I know that might not sound like such a good thing, but it really is. It goes back to the old idea that if you find yourself in a room full of people who all agree, an echo chamber, you should probably find yourself a different room. If you actually want to learn and improve your understanding of money, the best thing you can do is to listen to intelligent people who disagree with each other. The real answer, it's usually somewhere in the place where their beliefs overlap. If you're looking for YouTubers, check out Graham Stephan, Nate O'Brien, and Meet Kevin. They post some of the best, most honest content you're going to find on YouTube, and I've binged it for many years myself. The seventh and final rule of money, last but certainly not least, is to save up a rainy day fund. If the past few months and years they've taught us anything, it's that we have no idea what is around the corner for us. Life changes and it's just impossible to predict what is coming next. That's why we all need a rainy day fund saved up. And a general rule of thumb is to have a minimum of 6 to 12 months worth of expenses saved somewhere that is easily accessible. Now, we know from the second rule of money that investing your money is better in the long run than just holding cash. But we make an exception for the rainy day fund because the purpose of this money is to provide stability in your life. So it's important to keep that money somewhere that is the most stable possible, even if it means earning slightly less. So now that you know the 7 rules of money, the question is, what are you going to do? Are you going to implement them in your life? Let me know in the comments which methods that you're working on today. Every Tuesday and Friday, I share videos like this on finance and investing. Subscribe now so you don't miss them. And of course, thank you for watching.